Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Hello and welcome to this week's episode of the Prime Property Finance Podcast. My name is Mark, and in today's episode we're going to try to answer the question, or we will be answering the question, is buying a hotel a property strategy? Interesting. It's a conversation I've had quite a lot recently, and therefore I thought it'd be an interesting topic to cover off in this week's podcast. A lot of property investors are coming to us and looking or exploring the opportunity to buy a hotel. Hence the question, is it actually a property strategy? So we're going to dive into this in a bit more detail, but who is this episode for? So if you are a property investor that's looking to scale your portfolio, you're looking outside of your traditional residential properties or traditional commercial properties, then this is certainly an episode for you. No doubt you would have probably been presented with some hotel opportunities, or at least seen them and considered whether it's the right thing for you. So if that sounds like you, then carry on listening, and we'll hope to answer this question in a bit more detail for you. So let's get straight into it. Okay, so it's not a black and white answer as yes or no. It actually depends on what you intend on doing with the property, the hotel itself. Okay, so we'll start with the easy one, which is commercial investment. So if you're going to buy the property and you are going to do the works, do whatever you need to get it fully functional, and subsequently let it out to a third party, okay, someone like the Marriott, the Hilton, someone like that, then absolutely it is a property strategy, okay? The reason being is you will own the property, you'll have a tenant, okay? Irrespective of the fact it's a hotel, you'll just have a tenant that will operate it, and the strength or the income off of that property is based on the rental income. Okay, fairly easy to value as well, in so much that it is a yield-based valuation, depending on the strength of the covenant. The covenant is the lease and who is actually in occupancy. Now, if it's a little startup that's never traded before and you're renting it out, that's going to be very weak in terms of a covenant. If it is someone like the Marriott Hotel, that's going to be extremely strong. Okay, and the yields will reflect that as well. So, is buying a hotel a property strategy? Well, in terms of buying it and renting it out to a third party, absolutely, it is a property strategy like any other commercial property strategy. Okay, it's important to remember as well that if you are going to rent it out to a third party, it can't just be your operating company that's going to trade it. Okay, if that is the case, it will be considered owner-occupier, which is what we will come on to next. Okay, so that's important to remember. And you won't circumvent that with a lender. Okay, so that's important to recognize. It needs to be an arm's length third-party lease arrangement with an operator. The reason being, if they don't pay their rent, you're going to take legal action against them. If it's your company that's renting it off your company, you aren't going to take legal action against yourself. Okay, so that's why we treat the one I'm about to come on to as owner-occupier. With that being said, let's look at the hotel where you intend on operating it. Now, this is becoming quite popular, as I say. I think people can see there are potentially good returns with these, and the opportunity to be a bit more in control of what that's going to be, especially if you are a residential investor. Currently, the yields that are presented with some of these hotel opportunities are greater than residential, so I can certainly see the appeal. However, in many of the conversations that I have, I think there's a bit of a lack of understanding as to what actually goes into operating a hotel and some of the challenges that presents. So how does it differ? Well, basically, you are going to be responsible for the day-to-day operating of a business, okay? So this isn't owning a property, forgetting about it and getting your rent in on a monthly basis. This is going to be owning a property and making sure that it is occupied, that your operating costs are such that, and so on and so forth, okay? And if you haven't had direct experience in that sector, then trying to get a mortgage on that is going to be nigh on impossible. Doesn't mean you cannot get it altogether. You may have really strong, robust management teams that you can bring in and so on and so forth, but that is then going to impact your operating costs and so on. Okay, so as I say, this is very much a trading business conversation that we'll be having. Another question that gets asked a lot is, how do you value a hotel of this type? So we covered off the commercial investment one, that's quite straightforward. Trying to value a hotel in the trading sense is far more difficult. Now, there are many ways in which it can be valued, and the valuer will decide the best course of action in conjunction with the instruction that the lender gives. But an example of a couple of ways it may be valued is it could be a multiple of gross revenue, okay? Or it could be a multiple of something called EBITDA, earnings before tax, interest, depreciation, and amortization. If you're not sure what that is, I think we covered on a previous podcast. If not, we'll do it in another. Just Google it. Fairly straightforward. So it'll be a multiple of that. Okay, so this is a trading business that happens to have property involved with it. Those multiples will give you ultimately the value. So when we talk about commercial valuations, and this is really common in HMOs, hotels are probably the best example as to where a commercial valuation is the most relevant, and it's one that I use all the time. The reason being is the income is intrinsically linked to the property. A hotel cannot be used as any other type of accommodation. It can't be a family home all of a sudden. It can't be anything other than what it is, and therefore it will generate income on the basis of it being a hotel. Therefore, using its income as a multiple to judge, or to value, I should say, the property or the business that includes the property is exactly the right metric to use, and is used all of the time because, as I say, the property cannot be used for anything else other than its intended purpose. So that's the valuation, but there are obviously two sides to all mortgages. So you've got the value. So what can I lend as based on the value? Typically 65% is the maximum you'll get on a trading hotel. Unless, of course, you've got track record, numbers particularly strong, and so on and so forth. There needs to be mitigated circumstances, but you'd be setting your stall at around 65%. The reason for that is that we know how much difficulty the hospitality sector, not just through COVID, but has had for many years. It's a very difficult area to get right. Hence, the loan-to-values reflect the risk involved in that particular strategy. The other side to it then is the affordability. So whereas in commercial investment, we are looking at the rental income to assess the affordability as we would in any other buy-to-let or commercial investment property, this time we're now looking at the operating income of the hotel itself. Okay, so taking on board its gross revenue, taking on board its operating costs, and so on and so forth. We then analyze that and assess whether it's viable going forward, that it can afford the debt that you're about to put on it in terms of a mortgage. So what does that mean? That means that in extremely rare circumstances will we ever use forecast-only businesses. Invariably, there needs to be a track record for us to assess what the gross revenue will be, and also what the operating costs are, therefore getting down to what money is available to service any debt. Now, most lenders want to see 2 years trading history. So if we put that into a timeline, let's say you've gone and seen a hotel as an opportunity. You've gone and got yourself a bridging loan to go and buy that and do the works, for example. Okay, I'm not saying there's ready bridge lenders out there to do this, but this is just an example to demonstrate a point. That money is short-term in nature. Let's say you get that for 18 months. It takes you 6 to 9 months to get the project done and up and operational. You're now 6 months trading records, and you've got to repay your bridging loan. Okay, there's an issue because the lender is going to want to see 2 years worth of trading, so we've got a gap of 18 months. And this is where the challenge lies, really, is if you're new to this sector, then you need to have the capital to invest for the longer period, because realistically, you need to be in a project for 3 years before it's suitable for mortgages. You can do it for a year, and you will hear some lenders say, we'll take 1 year's accounts. Invariably, there are mitigating circumstances as to why they will accept 1 year rather than 2 years. And that's usually because there's a track record elsewhere. Okay, so it may be that you've got another hotel and this is your second one that you're buying, refurbishing, getting out there, etc. And they can see that you've successfully been operating one, or you were the main person in a business that was responsible for the operating of that business, therefore transferable skills and so on and so forth. Okay, so the emphasis on this is the fact that it is very much a trading business. Okay, lenders will want to understand your track record as well as the track record of the property that you're invested in. Therefore, the second version of this, hotel as an owner-occupier, is actually a trading business that happens to have property rather than a property strategy itself. So I hope that provides some clarity over the difference as to whether buying a hotel is indeed a property strategy or not. The answer is both yes and no, depending on the circumstance. It is possibly viable for some borrowers. There needs to be transferable skills. You will need a reasonable amount of capital to get this off the ground. You're unlikely to get yourself into a mortgage anytime soon. And so therefore you need to be able to trade and operate that. One of the ways that we suggest that people may want to do this, which de-risks it a little bit for you, is to consider something called an option agreement, whereby, if the hotel is vacant and you've got somebody who's just sitting on the asset, then you may be able to negotiate that you can operate the business for a period of time before you have to then go and buy it. Therefore, you can trade it, build up the track record without having the initial money to invest in the first instance. You'll need obviously a refurb cost and that sort of thing, but it's a far smaller capital requirement in that way. Also, it presents, as I say, a slightly less risk, because if it doesn't work, you can effectively close it and walk away without having a big old property around your neck that's not going to work as well. And one other thing that a bit of a share with you, which is a question I ask everybody who comes to us in regards to the owner-occupier model, is invariably these properties have been empty for a while. So the question that I would ask is, in an environment where hotels have been occupied through local council contracts, especially through COVID, and we've got the hangover of those arrangements still in existence today, why was that empty when it's never been easier? I'm not saying it's easy, but why was it's never been easier to have had those occupied in the first instance? So why? And also, if it's been empty for 5 years, what are you going to do different that means that it's going to be commercially viable going forward? As I say, this isn't just a buy-to-let where we know everybody needs homes. This is an actual business that is hospitality-driven, is in the hospitality sector. So the question would be, well, what's going to change that makes this commercially viable going forward? So always ask the question in these spaces as to why. Why is it empty? And so on and so forth. And also just do your numbers. Genuinely do your due diligence before you start raising investment or anything like that as well. All right. So there we go. Is buying a hotel a property strategy? Yes and no. Depends on what you want to do with it, really. If you're going to go down the owner-occupier route, it's a far more difficult route to tread unless you're already in the sector, have got track record, and have got a reasonable amount of capital behind you to get it done. So hope you found that useful. Thank you very much for listening, and I will catch you on the next one. Cheers, guys.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.